Today we have a special guest, one of the top popular investors on eToro. We personally use eToro for our public portfolio, and many of our videos are focused on analysis through the platform. So today it's great to talk with someone who has real experience, strong performance, and clear investment thesis, and using eToro for a really long time. So thank you for joining us today.
Hello, Pietari. I think you have some very interesting picks as well to see today. Yanis, would you like to start with the first question?
Yes. First, for people who may not know you yet, can you briefly introduce yourself and your investing background?
Sure. So I've been investing for 20 years. I've been doing like a few different things during this time. And I never thought that I would become an investor, actually. I studied computer science at university, but then just by chance, I took a finance course during my studies. Then I got more interested in the subject. I studied it more on my own. And then I opened my first trading account in 2004. The first thing I did was day trading. So that means holding your stocks only for a few hours up to a day. That went well, but it was quite stressful. So that's why I then developed my next strategy, which I ran from 2005 to 14. I invested in microcaps, small companies. And then in 2014, I noticed that competition in this space increased. And that's why I developed my current strategy. Today, I invest in medium-sized and large companies. And the name of my strategy is Triangular Capital. So triangular, that comes from the word triangle. So it refers to the three different types of analysis that I do to choose stocks. So I do a bit of macro analysis, a bit of fundamental analysis, and a bit of technical analysis. And I combine all of these three to try to find cheap stocks in my portfolio.
Great. This is very similar to our strategy. We also like to look at the macro trends, the news, which reflect its trend at every period, because every period there is at least one trend going on, one narrative on a long run. So yes, of course, what comes next is the fundamentals, which shows the value, and a technical analysis maybe at the end to show us entries and exit points. What percentage of weight would you say that you give at each one of these factors? Is something more important than the others?
So I would say that 50% of my strategy is macro. So macro is the single most important element in my strategy. And everything starts with macro. So I really want to position my portfolio into sectors that benefit from current macro trends and that are cheap. So both of these two things must be true at the same time. Then I would say maybe 30% is fundamental analysis. It's also important. I'm kind of like a value style investor. So I want to buy stocks which are cheaper than average within a sector. And then the final 20%, I would say, is technical analysis. So I want to kind of pinpoint the entry points, the exit points. I buy stocks which are more oversold and then sell stocks which are more overbought. So with technical analysis, I really like to keep it simple. So I don't use like any complicated indicators or some like any weird stuff, like some very obscure metrics, things like that. So for me, it's really about just like moving averages, support levels, resistance levels, the kind of simple things that you can think of. So what I like to do is I will look at the chart of the stock and I will just eyeball it visually. And I will try to find if there's any kind of support levels or resistance levels, any trends that I can identify. And then maybe, let's say, if I think it's in a trend, then I will try to buy it when it's more at the bottom of the trend channel and sell it when it's more at the top of the trend channel.
Okay. So you have a clear entry point. You exit your position when you think that the narrative is over, when you think that the resistance level is too much high. What is a crucial factor for exiting a position?
So there's like constant turnover in my portfolio, and it really depends on what stocks are overbought or oversold at any given moment. So every day I will look at the portfolio, and then if I think that a certain stock, it's gone up a lot recently in the last 1 month, it's become overbought, and especially if it has gone up a lot in the last few days, or maybe on that day itself, then I will think that maybe somebody wants to desperately buy that stock. So there's kind of liquidity demand for that stock on that day. And the idea here is really to provide liquidity to the market. So if somebody really wants to buy a stock desperately at a good price, then I'll be happy to sell that stock to that person.
Back in Cyprus, we have discussed that, as we said before, we have a really similar strategy on how we find stocks. But from the macro view, I want to ask you again, from the macro view, to identify the catalyst and then selecting the specific companies, what is your searching process?
So with macro news, the way I do it is I follow a number of investment banks, like their research. I read that on a daily basis. And actually a lot of my day is spent reading that research. So there tend to be like some themes that emerge out of that. So of course, different people will have a different macro view, but ultimately you have to kind of create a synthesis of all the different research that you read, come to your own view about what's going to happen in macro over the next 12 months, and then position your portfolio accordingly. So after I kind of like choose a sector which I think benefits from current macro trend, then I will go to the fundamental analysis process. And I have a computer program which I've written, and that will rank all of the stocks within the sector which came from the macro analysis. And I will look at the highest ranking stocks manually. So I can illustrate this with an example of this process. So at the moment, I'm quite bullish on European banks. So my portfolio is kind of concentrated in European banks. And that really comes from a couple of macro reasons. So I believe that the European economy is going to strengthen in 2026. I think the next move by the European Central Bank is going to be increase interest rates, not decrease. And the banking sector typically benefits when interest rates increase. I also think that there is a chance that there might be a peace in Ukraine, which would further strengthen the European economy. So let's say now I get this macro view that European banks will be like a good sector to invest in. So what do I do next? So then I will run this computer program for the European banks, and this will be a list of, let's say, 100 companies. And then it will rank like all those 100 European banks. And then I will focus maybe on the top 10 ranked banks. I will look at them manually, like what's happening with those companies. What is the problem with each company? Why is it like so cheap? And then I will try to determine like, is that reason more temporary or is it permanent? Can I live with that problem? Or am I too uncomfortable with that problem that I can't accept that problem? So then based on that analysis, the stock either ends up in my portfolio or not.
You're just into one narrative, the European bank sector, and you're purposely trying to avoid the AI trend, right?
Yes, I've been avoiding the AI trend because like usually I tend to focus more on the value sectors, like financials, industrials, real estate, healthcare, like this kind of old economy like sectors. And I don't usually have a lot of like technology exposure in my portfolio, or communications, services, consumer discretionary. These are the kind of sectors that I tend to avoid. And because of that, there's not been like any direct AI exposure in my portfolio. However, I actually think that the banks are going to benefit from AI a lot because they can use AI to cut cost. So there's many processes in the back office, also in customer service, which can be automated with the help of AI. You can already see it, like many banks are talking about that. I think for every bank, it's not super important to apply AI in their operations because otherwise the competitors will do it and then you will get left behind, right? So there's a lot of like cost-cutting opportunity for the banks from AI. And also on the revenue side, I think like AI, it requires a lot of data center investment so that banks can lend towards data centers. And also AI can be used like, for example, cross-sell products more effectively to the existing clients.
We have seen a lot of banks, European bank stocks run a lot. So do you think that this concept have already priced in?
I mean, partially, yes. Of course, the banks are not as cheap as they used to be. Like in 2023, 2024, like European banks were like extremely cheap. Like one of the best opportunities I've seen during my career. Because you could buy like good quality banks at like 5 times earnings, 6 times earnings, 7 times earnings. Those were like insanely low valuations. And now the banks have done like quite well. So 23, 24, 25, they went up, especially this year, they've done like super strongly. So you don't anymore get those 5, 6, 7 times earnings types of valuations. Now it's like 9 times earnings or 10 times earnings. However, if you look at the historical valuation ranges of these banks, then in the previous bullish times for the European economy and the banks, these same banks were trading at 12 times earnings. So right now they're at 9 to 10 times earnings. So I think that there is still like another 20% upside if the economy strengthens further in 2026. So we are now at kind of average valuations, but not at any kind of like extreme or like super bullish valuations. And at the same time, the quality of these banks is better than at any time, certainly since the financial crisis in 2008.
Also, in my view, when you look at data centers, energy infrastructure, power grids, Europe is still behind. So what's your view on this? Do you believe that is there any room for this kind of stocks to have a huge run like banks?
I mean, I think that AI is truly a transformative technology. So I studied computer science from 2000 to 2005. And I would say that from the year 2000 until the year 2022, nothing interesting happened in technology. That's my opinion. So we got the internet in 2000, and the next interesting thing was ChatGPT in 22 years, like later. So I think AI is going to change everything, absolutely everything. I mean, I can see it in my own work this year, how it's changing things. So to, for example, to do any kind of research, write articles, you can generate images, you can even generate videos now, you can edit images, you can do so many things with AI much more efficiently than what you could do in the past. And then you're going to have robots coming next. So it's not going to be just like knowledge work, which is going to be transformed, but even like physical work. You can already see the figure robot from the US. In China, you have the Unit 3 robot. I mean, these are doing some pretty cool stuff you can see in the videos now. So definitely the technology itself is going to be completely transformative over the next 5, 10, 20 years. Now, in terms of investing in AI, I think it will get dangerous at some point. Because I think what's going to happen is a big investment boom now, like this year, next year into 2027. I don't think we are in an AI bubble yet. I think things can get a lot more extreme because the technology is still developing very fast and there's like real benefits from it. So I think that the valuations in AI stocks can actually expand from current levels. So yes, we already see that Google has gone up a lot this year because of the AI effect. Yeah. Many other AI stocks have done well. I mean, we all know NVIDIA has been like a huge outperformer over the past several years. So yes, these stocks are getting a little bit on the expensive side, but it's not as crazy as it was in the year 2000 during the internet bubble. So if we get as crazy valuations as at that time, then we can easily get another 50% like rally in these stocks. So, and I wouldn't be surprised to see that happen. However, I'm not personally investing in that because it's just not my style. Like another example I can give you is like Bitcoin. I'm quite bullish on Bitcoin in terms of the price. Like I think it's going to go up because of various debasement things that are going to happen. But even then, I'm not going to invest in Bitcoin just because I'm more like a value guy and it doesn't really fit with my personality.
In my view, AI development in Europe will come with a delay. So companies that focusing on data centers, energy networks, power grids, all of these companies can play a major role. So you can't only invest in AI stocks like chip makers, etc. You can invest in stocks like, for example, Siemens, that building the power grids and all the infrastructure behind the AI. How do you see that kind of companies? Do you believe that they have room for going up in the future?
Like one interesting example you just gave us, the utility sector. Maybe you've seen in the US that it has done extremely well this year because of the AI effect. And in Europe as well, I think some of the utility stocks, they have started to do a little bit better. And I think that can continue because it's a big kind of like inflection in the trend for power demand. Like for so long, it was all about efficiency. And in that case, the demand for electricity like never grew for so many years. Now we are finally getting that growth. So it's like a very big change for the environment that these companies operate in. Now, if I look at some of the other kind of AI adjacent plays in Europe, so you have, you mentioned Siemens, you will have other kind of electrification kind of plays like Schneider Electric is a good example.
Yeah.
So these kind of companies will definitely benefit heavily from AI demand. However, it's also reflected in the valuations of these companies. So like Schneider always trading at more than 20 times earnings. It's not necessarily expensive, but also it's not like a, the kind of like bargain like stock, because people of course understand that the growth is going to be there like for this company. So again, it's not like really 100% within my style to invest in these companies, because I really look for like low PE companies. And then these kind of like AI adjacent plays are also not low AI. Not low PE.
Low PE, you mean like under 10, near 10s?
I mean, at least under 15. Like even better if it's under 10, but those kind of companies are getting more difficult to find. I'll give you like one example of a kind of AI stock. It does have a less than 10 PE. And I invested in this earlier, and I'm still invested in it. But it's actually one of company which does not benefit from AI, or at least people think that it's actually going to be hurt by AI. So it's a French company called Teleperformance. So they do call centers. And now people think that because of AI, soon the AI agent can do the call center functions. So maybe this company's services will not be needed anymore. And that's why this stock is trading at 5 times, 6 times PE, so the very low valuation. So the question is, how bad is it really going to get for this company? Like, is AI really going to take over the customer relation function completely? Now, personally, I don't think so. But there's different opinions about it, debate about it. So some companies which the market views as being hurt by AI can actually be bought at a very good price today.
Have you also checked the short interest on this specific stock, Teleperformance, you said?
Yes, so there is a lot of short interest in it. So a lot of people are shorting it. And that's because they believe that the AI is really going to destroy the business of this company. So there's different opinions about it out there.
You said before that you believe that interest rates in Europe is going to be increased. Do you think what will be the impact in the European stock market?
So I think, first of all, it's going to strengthen the euro. And that's good for the international investor. I think the euro is still a little bit undervalued compared to the US dollar. And there's some reasons to believe that the US dollar will actually weaken over the next year. So I wouldn't be surprised to see the euro versus the dollar at 125 in a year's time. So that's the first good news for the kind of international investor about higher interest rates. So the kind of the currency effect. You get the currency appreciation if you're not euro-based, or at least you won't lose money if you are euro-based. Then if you look at the stock market itself, now that will depend on the sector, right? So traditionally, the sector which mostly benefits from higher interest rates is financials. So you're talking about banks and insurance companies, because these guys, obviously banks lend money out, insurance company invests the client's money in interest rate paper. So the more interest they get, the better for them, like in general and on average. So that's why I'm also quite bullish like on this financial sector, like banks, insurers at the moment. Then if you think about the kind of sectors which traditionally are hurt by higher interest rates, and there's real estate. I think that there will be some like companies which will be hurt in that space by the higher interest rates. So for example, German residential property has been, it went down a lot in 2022 when interest rates went up. So if they again start going up, then, of course, the valuations are already quite low compared to back then. So they won't go maybe down as much as at that time. But still, I wouldn't be like that bullish on both companies just because of the macro like environment, higher interest rates. I think there will be some other companies in real estate which will be okay because there can be some big discounts now compared to net asset value in that sector. So I think people are already a little bit pessimistic about real estate companies. So it seems like they are already a bit fearful about higher interest rates. And in part, it's already reflected in the price of those companies. So, I mean, that's like an interesting case where you don't really kind of 100% sure about what's going to happen. On the other hand, you have the cheap valuations, but then on the other hand, you have like the higher interest rates. So we'll have to see like next year.
So you are bullish on real estate, right? And companies working in real estate sector.
So I would say maybe more those kind of like real estate companies which benefit from a stronger economy. So one example would be office property companies. So office property has been like really bad for many years because of COVID. So people started working from home and the vacancy rate on office property increased. And then people got like really cautious about that asset class. And you can see it in the valuations today. So some office property companies are selling at a 40% discount to the underlying value of the properties that they own. So that's like a pretty big discount. And it really reflects the pessimism which people have about office property. Like I personally am a little bit more optimistic about those offices. So I think if you look at some of the data, then like the vacancies seem to be stable. You have a lot less supply coming up. And especially in the big financial centers like London, the best quality office property is actually in demand. So yes, the average quality, no, that's not good at all. But if you look at the grade A quality office, then actually people are like scrambling to rent it because companies need to get people back to the office, or that's what they want. And to do it, they need like really high quality office space. So the best space, the demand is there.
Except the European market, are you investing in another market, in the US market?
So I have like zero US stocks in my portfolio. So that's a bit unusual because, of course, the US is the majority of the world market. I am, however, invested in some emerging market stocks. I have like one Brazilian bank in my portfolio, for example, and I'm actively looking at some other opportunities. I find that South Korea, for example, is interesting at the moment. It's gone up a lot already this year, but I think because of all the positive macro developments there, it can still go up more next year.
What do you think about the Japan market? Now Japan is starting increasing the interest rates. So what do you believe about the bank sector in Japan?
The bank sector in Japan, I mean, it's a reasonable bet, I think, but not as good as European banks, in my opinion. And the reason for that is valuation. So the big Japanese banks, they trade at like 12 times earnings. And that's like a normal valuation for a big bank. So you don't get like a 10 times earnings like in Europe. It maybe go up to 12, so 20% upside. Japanese banks are already at 12 times earnings. So that's why I think that there's more upside in Europe compared to Japan. The fundamentals of Japanese banks are very good because interest rates are starting to increase in Japan and they will gradually continue to increase. But I also think that the Japanese interest rate market has gone a little bit ahead of itself. So it seems like a kind of lot of good news about the Japanese economy is now in the price. So I think the Japanese 10-year is almost at 2% now. So that's already kind of like a target level, so to speak. I mean, I don't really see it going up a lot from there over the next 12 months. And then if it just stays stable at current levels and doesn't increase, and like banks, I mean, they always benefit from higher interest rates, right? So then they would only be like an average kind of investment if the interest rates don't increase.
So do you believe that it's already priced in?
Yes, and I think a lot of the Japanese good news is now priced in. The Nikkei has done like really well over the past couple of months because of the new government. And I think there's maybe some scope for like a temporary disappointment, I would say. In the longer run, I think Japan is going to be good. I think over the next 5 years, it's going to perform well. But I'm just not so bullish on like a shorter term horizon.
And except from banks, are you seeing in the future another sector that will be benefit, or it's do you want to invest in to start positioning from now for the future?
Well, I'm really keeping an eye out on real estate. So as soon as I get the view that interest rates are going to be stable or even going to decrease, I might heavily go into real estate at that point, because I can really see that there's many companies in Europe, in the real estate sector, where the valuations are like super attractive. There's a big discount to the net asset value, meaning the value of the properties that these companies own. So the only kind of question mark, and the reason I'm not heavily in real estate at the moment, is the interest rates. So the kind of the macro view you have about them. And I really think the ECB is going to start increasing rates end of 26 and in early 27. And I do think that the 10-year German yield, which at the moment is about 2.8%, over the next few years, it's going to increase to as high as 4%. I definitely think next year it's going to go about 3%, maybe 3.25. And then it could even gradually increase from there over the following years. So when you have this kind of macro view, it's difficult to concentrate heavily into real estate, because they do trade on a shorter term basis based on the interest rates. So when interest rates go up, then real estate stocks tend to go down. So that is the difficulty I have with that.
I also believe that it's unlikely necessary for the European interest rates to go up. But for the people who are watching us, do you want to explain why you are believe that interest rates in Europe will go up?
Sure. So I really believe that the European economy is going to strengthen next year. Typically, strengthening economy means higher interest rates. So inflation at the moment in Europe is quite stable. It's at a good level. So the European Central Bank is at a kind of neutral policy posture, so at 2%. But I think if the economy strengthens, then they might have to move to a more restrictive posture, meaning interest rates should be more than 2%. Maybe they should be 2.5%. Maybe they should be 3%. And then if you look at the longer term interest rates, like the 10-year interest rate I mentioned earlier, so that consists of two components. So first of all, there is the average short-term rate over the next 10 years, the market's assessment about that. So basically the average European Central Bank rate over the next 10 years. And then on top of that, there is something called the term premium. So that is like something to compensate investors for holding their extra risk in the longer term bonds. Because otherwise it would be just much nicer to hold short-term bonds and roll them over for 10 years. Like every time you would roll over 3-month bonds, 4 times a year, and then 40 times altogether over 10 years. But no, you want to buy a 10-year bond in one go, right? But it's riskier than rolling over 3 months, 4 times a year. And you need some compensation for that. So basically a higher interest rate. And now this amount of compensation, it varies from 1 year to the next. It depends on bond supply. So how much bonds governments have to issue. And now we have a German fiscal stimulus coming in. So Germany is really expanding the fiscal deficit this year and next year. So it means that Germany will be issuing a lot more bonds. And for investors to buy all of those bonds, they need to get a better price. Otherwise, they will not buy those bonds. So that means that the term premium should go up. Investors should get more compensation for holding those longer-term bonds. And that is another reason, on top of the strength in the economy, why I think that the longer-term interest rates will go up next year.
The US dollar has already been beaten down. So you think there's much more room to go further?
I think there is potentially much more room to go, actually. Because if the new guy really manages to lower the rates, then we could really see a big fall, actually, in the dollar. If something like a yield curve control, so people are talking about this like YCC, yield curve control. If they ever manage to implement something like that, then I think the dollar could properly crash.
This the lower interest rates and a weaker US dollar, it will be short term good for high growth stocks. But in the long run, I also believe that it will hurt in some point the US economy.
Yeah, I mean, the market always hates uncertainty. So now with the new Fed chair, there's going to be more uncertainty. And Donald Trump himself is always unpredictable, right? I mean, you don't know what's going to happen. So he already put the tariffs in place this year. and he kind of canceled them. So there was a lot of volatility because of that. So I think that's going to continue in the US. And then you could see that this year, one of the reasons why the euro strengthened was exactly because of this. Like all the uncertainty, people don't like it. And then they are not as happy as before to hold US dollars. And I think this reallocation process still has further to go.
Shall we proceed to the next chapter? Maybe, Pietari, would you like to share with us some of the best picks that you have made over the years, some of the most memorable stocks that you have owned?
Well, certainly the most memorable moment during the 20 years that I've been investing was the day when the COVID vaccine was announced, like the results of the trial, that is like 90% effective against COVID. So in 2020, in March, I had lost first a lot of money by being invested in cyclical stocks. And my portfolio had recovered all of that loss, I would say around May that year. And then I went into more kind of risky stocks because I thought that, the next move in the economy has to be up, like has to be an improvement. So I kind of believe that we are going to get out of that situation. Maybe there's going to be a vaccine. But nobody knew at that time. Like in 2020, it was still a lot of uncertainty about what would happen with the virus. So in any case, in October 2020, stocks actually went down. So I lost like a decent chunk of money that month. And it seemed like maybe nothing is going to come out of all of this. We're just going to keep having those lockdowns and this virus is just going to continue rampant. But then, of course, we know that after that in November, the vaccine came. So I remember reading about that news and just jumping up and down at home and then being just so incredibly happy that this is how it worked out. I mean, I always believed in it. You have to be an optimist in the market to make money in the long run. And it really paid off that day. So November 2020, it was the best month for my portfolio during this whole 20 years.
And what was the most difficult year, the most difficult years of your career?
That certainly was 2018. So my view that year was that there would be no recession. And that's why I was kind of happy to be positioned in more risky stocks throughout the year. Now, the problem is that in 2018, the economy slowed down. And although it was ultimately correct that there would be no recession, it didn't really matter because all these cyclical stocks went down 25%. So if you had a portfolio full of them, then you lost 25%, which is what I did. So that was a terrible year for me. And I remember at Christmas 2018, it was not a Merry Christmas because the portfolio had lost a lot of money. And I really felt terrible because I hadn't had enough respect for the market, the economy, just the direction of it. That just a slowdown will cause a 25% drop in cyclical stocks. So, I mean, it was a really difficult time. But I think the lesson I took from that was that, first of all, take less risk when the economy is slowing down. So maybe have more kind of defensive posture, which is what I then implemented in 2022, which was a good year for me. And also the second one, and this is perhaps the most important one, is just to keep investing, keep going. But there will be difficult times for every investor in their careers. But if you stop investing after a loss, then you crystallize that loss and you cannot recover anymore. So in 2019, my portfolio recovered all of that loss from 2018 and even some more. So, I mean, after that, it was great. And every year has been great since then. But you just have to kind of accept that psychological pain at that time and then just keep going.
It's true. They say that after a strong pullback comes an even stronger upside.
In the long run, yes. Because stocks go up in the long run. And that is what you have to really believe in. In 1 year, stocks can always go down. We've had even much worse years than 25%. In 2008, stocks lost 50%. And the same after the internet bubble in 2000. The stock market lost 50% over 2-3 years. But again, after that, stocks have gone up so much. So if you just keep the long-term horizon, then that is how you make money. And it really compounds like wealth over time. Like if you make just 5% a year, then over 100 years, you can make like 130 times return or something like that. So you can really kind of change your life by being invested for long enough. But it takes patience. So you have to kind of be able to accept these drawdowns, which come for every investor from time to time. And the longer your horizon is, the better. And I think the thing to avoid will be what many individual investors do, which is to sell after losses and buy after gains. So if anything, you should do the opposite. So more like buy after losses and then sell after gains if you want to try to time the market. But at least do not like sell after the big decline when everybody else is panicking. The news is terrible. Like all the newspapers are saying that now there's going to be a recession, there's a crisis. These are actually the times to buy. When there's a crisis, it's a time to buy.
We also had some future outlook, but I guess that Pietari also gave us some future outlook with stock picking on banks and REITs. So as far as I understood, you're saying that in the next years, we will be seeing interest rates higher. So bank companies and stocks going much higher. And after that, it's the time to invest in REITs because the rates will be going down. So this is the structure for someone who wants to copy your style, maybe.
Yeah, so that is kind of the plan at the moment for the next few years. But of course, the market always sometimes throws some curveballs at you. So something totally unexpected happens, and then you will need to react to that. But I mean, that's what also makes investing interesting. I mean, it's not always like just going everything as planned, but you also have to react to new events.
I think it's time to wrap this up. Pietari, it was great to have you here, to talk with you, get to know you better and your investing style, some more about it and something from your past. It was great. I hope that we can talk again in some later call or maybe at some event with eToro.
Yes, thank you, Marius. Thank you, Yanis, for having me here. It's been a pleasure. I'm looking forward to next time.
I think it was extremely valuable, especially for investors trying to understand Europe beyond headlines. So thank you very much for being here with us and hope to make a video again together in the future.
Yes, definitely at the next event for sure.